Collateral, often called collateral security, is an asset that's been pledged by a borrower to a lender in support of a credit request. Examples of collateral include a vehicle for a car loan, a house or other type of property for a mortgage loan, or even marketable securities like stocks and bonds for a margin loan in an investment portfolio. When a specific asset is pledged as collateral for a loan, the credit exposure is said to be secured, as opposed to credit extended without specific underlying collateral, which is called unsecured borrowing. An asset becomes collateral when the lender registers a security interest, often called a lien or a charge. That lien could be against the serial number of a specific vehicle or against title of a specific property. Sometimes a security charge is registered against all assets of a borrower, which is very common in commercial lending. This is typically registered using what's called a general security agreement, and it covers all assets that can't necessarily be identified with a unique serial number or legal address. Think things like inventory and accounts receivable. If a borrower of secured credit triggers an event of default that can't be resolved or refinanced elsewhere, the lender will take what's called enforcement action against the collateral, likely liquidating it to recover as much of their outstanding credit exposure as possible. The best and highest quality security is collateral that scores highly against the MAST framework. MAST stands for marketable, ascertainable, stable, and transferable. Ask yourself, is the asset sought after? So, is there an active secondary market for it? How easy is it to agree upon its value? Meaning, how ascertainable is it? Assuming that multiple parties may want the asset and can agree on its value, how stable is that value likely to remain over time? And finally, how easy would it be to transfer title of the asset if a lender were required to take enforcement action? Most financial institutions have credit policies around how much they're willing to lend against different asset classes. This is what's called loan to value, or LTV. Think 50%, 75%, 90%, and so on. Assets that score higher against the MAST framework tend to support higher loan to values than those that score lower.